It was a mixed bag for the markets today. The Nasdaq set a new all-time high, but the S&P fell just short of a record of its own, and the Dow is down triple digits. Our next guest says the record run on Wall Street starting to run out of steam. Let's bring in Chris Harvey, head of equity strategy at Wells Fargo Securities. He was last on Fast Money in September, and he said then that equities were headed higher, and he was right. The S&P up 4% since that call. So, of course, the question is, where do we go from here? Welcome back, Chris. Nice to have you.
Good to be back.
All right, why are we running out of steam?
So we're running out of steam for a couple of reasons, right? We always talk about the wall of worry. Now what we see is the top of the wall of worry. But more importantly, it's the risk reward. You're playing for limited upside and a growing amount of downside. And our price target is 30.88. We're about 1% away from that. And what we said is, once we get there, okay, we're not saying we're out, but what we want to see is people become more optimistic, more bullish. We want to see the bears capitulate. And other than that, we've pretty much seen that in spades, right? And so now what we're looking for is we're doing it piecemeal, right? So in early September, we upgraded the banks. Now what we're saying is if you haven't gotten in the banks, you want to wait because we expect to see underperformance in the short term. We've been all over the semi-trade for a few months now. And now we're saying we're getting a little less enthusiastic at this point in time. And lastly, when we look at trade and tariff, Trump has a history of when the market's high, when things are good, for him to start pressing his bets a little bit. And I don't think that's priced into the market just yet.
That's the wall of worry? Are those the main ones, or is there something else you missed?
Well, no. That pretty much covers everything at this point in time.
Chris, there's to me also this dynamic where the stealth easing that the Fed has done. There's $280 billion more on the balance sheet than there was 6 weeks ago, or maybe 8 weeks ago. How much of that is a sugar high, or how much of that stays with us? I mean, I don't think they can unwind that anytime soon. But that, to me, has been an equity bonanza.
Right. So there are a couple things that happened. You had the Fed cutting rates, you had the Fed flooding the market with liquidity, and what you had were bank earnings that were actually much better than expected. So I think you're right. It's going to be with us for some period of time, which is why the market continues to grind higher, but you can't bet longer term. When we look into 2020, 2021, 2022, what you should expect to see from the capital markets are much more pedestrian-like returns, more like single-digit returns. But right here, right now, we're talking about melt-up. We're talking about the bears capitulating. There's a little bit more upside, but the risk-reward just doesn't look that attractive.
So talk about the risk-reward. If you think there is a China deal, let's say there is,
right.
Is it already fully priced in? Would there be anything left for that?
We think most, if not all of it, is priced in at this point in time. So this is different than tax reform. With tax reform, once you got that, you could say, okay, EPS numbers are going to go X% higher. Right? And then we can price that in. Here, what we're talking about is some ag being done. As we go down the road, too, we've been talking about IP and we're talking about market access. The problem is the Chinese have a built-in excuse. We're investigating big tech at this point in time. The Chinese excuse is, hey, you guys don't trust big tech. Why should we trust big tech? Why would we open those markets to you? So in the short term, yes, I do think we get something on the table. Much of it's priced in. But as we look longer term, it's going to be a lot more difficult to get material amount of trade and tariff goods on the table.
And what if we don't? What if December 15th comes, the tariffs actually go up and new ones go on, and there's no deal?
It's not a pretty story, which is why we're starting to say you want to start taking money off the table. You want to start being more conservatively positioned. You want to look for opportunities to de-risk the portfolio at this point.
Where are you in yields? Because obviously earlier in the year when we saw the 10-year Treasury kind of going back to those multi-year lows at 145 or something like that, I think a lot of equity investors were trained to like in there, but really it was kind of a growth concern. So we had that bounce to 195. Here we are at 178. If they start going back down there, what does that mean for equities?
What that means for equities is it's more of a risk-on environment. Right? So we should start to see equities be a bit more challenged. Multiples should start to be compressed. You should start to see more of your low vol trades start to work out. You should start to see your high growth work out. And you should start to see value roll over. But more importantly, you should see the market roll over.
Chris, thanks.
Thank you.
Chris Harvey joining us. Guy, what do you make of the market right now in terms of where it stands to this China point, the China trade deal? I find it a little surprising, perhaps, that we haven't given up more with some negative headlines lately. Yesterday, Eunice Yoon reporting that, Chinese officials are sort of saying, we may just stand back and see what happens. And yet we've gone higher.
Yeah, I'm shocked by it because I thought if you had told me that news the night before, it said the S&P's going to be down 35, 40 handles, and it wasn't. Then Gary Cohn on our show last night talks about the president will absolutely not flinch on December 15th, which I happen to agree with. I don't think we're any closer to a deal today than we were back in March, but the market doesn't seem to care. So I'm shocked that the VIX has a 13 handle and the S&P's at an all-time high. Quickly, though, the Russell is measured by the IWM. That topped out in August 2018 around 173. We've had a nice run, but we're nowhere near those levels. So the Russell's telling a much different story, in my opinion, than the broader market. This 160 level in the IWM, it's topped out a number of times. I think it turns lower. So I think what there's a bull market in and a bubble in is absolutely in complacency, in my opinion.
Yeah, I'll just mention that, I am going to be the last bull to capitulate there, Harvey. No, but, listen, when we've had, he mentioned December 7th.
Did you call yourself a bull?
No, he'll be the
Well,
last.
whatever. The upshot of it is, at late 17, after we had that tax cut, we just saw the market explode, right? It just seemed like everyone just threw caution to the wind. And what happened? We spent 9 months after that really milling around here and not being able to make any progress. And then they went back and they made a new high, and then we dropped 20% in late 2018. So, at the end of the day, I think that these kind of complacent markets, Guy just mentioned, VIX at 13, people are not pricing in any risk to a non-deal happening, sets up when you are at all-time highs for these sorts of corrections. And I think a lot of bullish strategists are starting to suggest that we might see that pullback maybe back towards 2,800 in Q1.